This meeting is called to order. Good afternoon. July 21st, 2011 marked the one-year anniversary since the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act. The date also marked the day where the Consumer Financial Protection Bureau assumes authority for regulating consumer financial products and services. While milestones are usually celebrated, this one is marked by uncertainty because the true effect of this bureaucracy remains to be seen. The CFPB was given extraordinary broad oversight powers to fundamentally change the way both banks and non-banks are regulated. In the rush to establish the CFPB, I believe that a fundamental element of regulation was lost. That is a comprehensive review of how rules will affect the industry and whether the financial products are meeting the needs of consumers. All of us in this room today are consumers of goods and services. I don't think anyone here wakes up in the morning and says, I want to be a victim of unfair, deceptive, or abusive practices. No one here wants to end up in bankruptcy. No entrepreneur wakes up in the morning and says, I'm going to start a business and it will fail. Our society is built on optimism, on the optimism of entrepreneurs who will wake up in the morning and say, I have a great idea for a business. With this optimism about business creation comes the responsibility to make the right decisions to best position your business for success. What we need to do is create a vibrant marketplace. Creating onerous rules and regulations on an industry is not the answer and is likely to have an adverse effect by driving many providers out of the marketplace. A banking relationship is a partnership. A bank that abuses its customers might make money in the short term, but they will not be in business for very long. We need to find a system that goes after those bad actors without impeding the ability of good actors to help build their communities. I am looking forward to hearing from both the CFPB to see how they envision the new Bureau operating and learn about what provisions they are putting into place to protect small businesses from the burdens of overregulation. I am also looking forward to hearing from small businesses about how the new Bureau will affect them and their businesses. With unemployment remaining above 9%, we need to do everything we can to avoid further burdening our job creators and regulation that will not add meaningful protections. With that, I would like to yield to Ranking Member Altmaier for his opening statement.
Thank you, Mr. Chairman. It was just over 1 year ago that the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law. Perhaps no other part of this law has attracted as much attention as the creation of the Consumer Financial Protection Bureau. Last week, the Bureau officially assumed its duties, making this an ideal time to step back and take stock of how this law will affect our nation's small businesses. While the authority of this new regulator will primarily extend only to financial products that are marketed to consumers, its rules will affect small business owners as well. According to the last Federal Reserve survey on small business finance, nearly half of all small firms use personal credit cards to finance their enterprise. In another survey, 1 in 5 entrepreneurs reported using a home equity loan for business purposes. These findings guarantee that the rules developed by the Bureau will inevitably have an impact on access to capital for small businesses. It's imperative that the agency develops these regulations. We bear in mind the needs of small businesses and not further worsen the current credit shortage for small firms. For precisely this reason, significant efforts were made to ensure that potentially negative effects of the small business community were mitigated by excluding merchants and retailers, as well as businesses that are already subject to insurance or securities regulation at the state level. Additionally, some entire industries were excluded from the Bureau's authority, such as realtors and auto dealers. Clearly, lawmakers recognized that small businesses were not the cause of the financial crisis and should therefore not bear the burden of the new regulations. An additional safeguard for the Bureau will be subject to the Regulatory Flexibility Act and the Small Business Regulatory Enforcement Fairness Act. These laws will ensure that small businesses have opportunity to participate in the CFPB's rulemaking process. This will help reduce the potential impact on small businesses while minimizing additional cost for small firms. So, Mr. Chairman, since we're approaching a vote, if I could just insert the rest of my statement into the record and we could move on with the hearing.
Very well. They've just called votes. Welcome to the United States House of Representatives. I think this is going to be a long series. So it looks like it's going to be about an hour. We're going to have to recess for an hour. Then we will come back immediately after the last vote to resume our hearing. And I apologize for that, but welcome to representative government. The committee is now in session. I would like to take a moment to mention that the subcommittee has received a statement for the record from the Independent Community Bankers of America. And without objection, I would like to insert this statement in the record. Hearing none, the statement will be inserted into the record. If committee members have an opening statement prepared, I ask that they be submitted for the record. I would like to take a moment to explain the timing lights for you. You will each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, the light will turn yellow. Finally, it will turn red at the end of your 5 minutes. I ask that you try to keep it to that time limit, but I will be a little lenient as you finish. Our first witness today is here representing the Consumer Financial Protection Bureau. Dan Sokolov, have I got that right? Sokolov is Deputy Associate Director for Research, Markets, and Regulations. This division is responsible for understanding consumer financial markets and evaluating whether there is a need for regulation and the cost and benefit of potential or existing regulation. Prior to joining the CFPB, Mr. Sokolov held positions with the Department of the Treasury and served as an attorney for the Federal Reserve. Mr. Sokolov, we look forward to your testimony.
On the subject of small business and the Consumer Financial Protection Bureau. The CFPB is the federal agency accountable for establishing clear rules of the road for the consumer financial marketplace. And Mr. Chairman, you mentioned the importance of a vibrant marketplace. That is precisely what we are striving for. Although the Bureau's jurisdiction is very limited with regard to small business credit, we take our responsibilities in this area very seriously. We recognize that small businesses are critical to the nation's economy and that small financial services providers are a critical source of products and services for millions of consumers. Today, I want to provide a brief update on the stand-up of the CFPB, as well as explain our efforts to reduce and avoid unwarranted regulatory burdens on small providers, and how we at the CFPB believe we may be able to assist small business borrowers over time. The Bureau opened for business last Thursday, July 21st. The Inspectors General of the Treasury Department and Federal Reserve Board have reported favorably on our efforts to stand up this agency. We are already at work strengthening consumer financial markets. We are working toward a market where consumers can readily see prices and risks and compare products so they make the choices that they believe are best for them. We have taken input from thousands of individual consumers and mortgage lenders and brokers on how to simplify federal mortgage disclosures and make them less burdensome. We are launching our program for supervising the largest banks and their affiliates. We are taking our first consumer complaints about credit cards, and Holly Petraeus has set up a strong Office of Service Member Affairs, reaching out to military families and working to address the unique financial challenges that they face. To fulfill the mandate established by Congress, we have hired an expert staff from the private, public, and nonprofit sectors. They are striving to build an agency that is smart, effective, and balanced. At the CFPB, we have been building into the agency's DNA extensive outreach to small financial institutions such as community banks and credit unions. We believe in the importance of a financial services marketplace where small providers can thrive. We will work to reduce regulatory burdens on small financial service providers wherever possible And we can take as an example disclosure reform. We understand lenders' deep frustration with the current mortgage forms required by federal law. They're complicated, sometimes duplicative, and more costly to fill out than they need to be. So we have solicited feedback from thousands of consumers, lenders, and brokers to help us make the disclosures simpler to use and easier to complete. Minimizing regulatory burden will continue to be a priority for us. Often, a regulation is not the best answer to a problem. Congress has given us many different tools to address problems in consumer financial markets. We will strive to address problems as we see them as effectively as we can and through the least burdensome means available to us. In addition, we will consider the potential benefits and costs of proposed regulations for consumers and covered persons, including small lenders. We will diligently comply with the Regulatory Flexibility Act, and we will follow the requirements of the Small Business Regulatory Enforcement Fairness Act, known as SBREFA. Our statutory objectives and statutory authorities do focus on financial products and services for consumers. The Bureau does not have jurisdiction over business credit, except in limited cases where Congress has explicitly and affirmatively granted the Bureau such jurisdiction. We recognize that a vibrant small business sector is critical to our economy, and we're aware that many small businesses today report having difficulty obtaining credit, a difficulty rooted in the most severe financial crisis since the Great Depression. So, although our role with respect to small business credit is quite limited, we hope to help many small business owners in 3 ways. First, we will implement diligently the Equal Credit Opportunity Act. This law prohibits discrimination in business lending. Second, as required by law, we will provide the public new data that may shed new light on the demand for and supply of small business credit. We will move deliberately, and we will consult widely to attempt to maximize the benefit of these loan data for small businesses and to minimize the cost for the lenders that will report the data. Third, we will work to ensure that consumer credit histories are as accurate as possible. More accurate credit histories would help startups. New business owners frequently rely on their personal credit histories to apply for their first business loan. We believe that a fairer and more transparent consumer financial services marketplace will be a boon to financial services providers of all sizes, and a more level playing field will benefit the smaller ones in particular. Thank you, and I look forward to your questions.
Thank you, Mr. Sokoloff. The CFPB recently sent a letter to the CEOs of financial institutions informing them that they are now subject to the jurisdiction of the Bureau. 26 of these lenders are on SBA's list of 100 top SBA lenders. These 26 lenders issued a total of 5,334 loans for approximately $1.5 billion. That's just looking at SBA's top 100 lenders and only at their SBA-backed loans. If is CFPB considering how actions against larger institutions will impact small business lending?
The letter you're referring to the CEOs, Mr. Chairman, was sort of introducing our program of supervision. That's a program that is by statute focused on the depository side. It is focused on depositories with $10 billion in assets or larger and their affiliates, just to put that into full context. That process of supervision, which is essentially working with the institutions by sending examiners to them and understanding how they operate and understanding their businesses and understanding where there may be questions about their compliance with applicable federal laws. That process is focused on the consumer protections. And as I said, our jurisdiction over business credit is quite limited. Where it's the main exception is in the area of implementation of the Equal Credit Opportunity Act, and in that area, as we're required, that will be an important part of our process.
Federal Reserve Chairman Bernanke recently stated that there has been no examination about the impact of the new regulatory environment will have on the overall economy. Has CFPB done any such study on how the Bureau fully implemented will affect the economy?
Mr. Chairman, can you repeat the question again?
Sure. Federal Reserve Chairman Bernanke recently stated that there has been no examination about the impact of the new regulatory environment, what it will have on the overall economy. And has your organization done any studies about when you're fully implemented, what impact it will have on the economy?
Well, we're still in the process of building out our processes. As I've said, we've launched our supervision program. We're taking complaints from consumers on credit cards. We're working diligently in the area of regulations. Our focus is on regulations that Congress has directed us to adopt and implement, under the Dodd-Frank Act. And so, in cases such as that, we're doing Congress's will, where Congress has made judgments about the benefits of certain policies for the economy.
One of my concerns about CFPB is that when you have an agency charged with looking for problems, they have a tendency to find them, whether they exist or not. How well we know when we have a financial system that is free of abusive practices, what steps are in place or benchmarks exist to know if CFPB has achieved its mission?
So we indeed are focused as part of our core mission on working towards a marketplace that is free of unfair, deceptive practices. It can be challenging to identify, the full range of acts and practices in an economy as large as ours. We're going to use all available sources of information, though, to see where risks to consumers may lie and where compliance risks may lie. And our sources of information will include, as I mentioned, our examination function, which is one of the important tools that Congress has provided us, and a tool that we can use to try to provide a level playing field between institutions that have bank charters and financial services providers that compete in the same market but are not banks. And we have a research capacity that we're building as well. We have teams that are designed to be expert in particular markets, where often we're hiring people who have expertise in specific industries. So we plan to take in information from a wide variety of sources to best understand what is going on, to be responsive, and to have a smart, balanced, and effective approach.
Thank you. Mr. Altmaier?
Thank you, Mr. Chairman. As I mentioned in my opening statement, with 1 in 5 entrepreneurs reportedly using home equity loans for business purposes, and nearly half of all small businesses relying on personal credit cards for capital, consumer financial products provide a critical source of capital for many small firms. How will your agency tailor its oversight of these products to ensure that small businesses do not find their access to credit unduly restricted by the new regulations?
Thank you, Mr. Altmaier, for that question. And we talk a bit about this in our written testimony as well. There is certainly some overlap. There are some small businesses that for some periods in the life of the business do use personal credit, and we're aware of that, and we wanted, in fact, as we said, to address that in our testimony. I think that the amount of overlap varies over time, and what we're going to look to, for example, in understanding that overlap is just as an example to what extent small businesses are using credit cards that are designed for consumers to make payments, and to what extent they're actually borrowing on the card. And we bring some data on that point in our testimony based on a Federal Reserve study and a survey by the National Federation of Independent Businesses. So, and we've already started to reach out to these other organizations to make sure that we do understand where this overlap might be.
We, on this committee and back home, I as well, continue to hear from small firms who are concerned that they'll be subject to CFPB oversight for financial transactions they provide to other businesses. Will your agency attempt to exercise oversight over financial products when no consumer is involved?
As I mentioned, our jurisdiction over small business credit is quite limited. There are a couple of fairly limited provisions in the Truth in Lending Act where Congress has extended protections to business credit cards. And then there's our obligation to implement the Equal Credit Opportunity Act, where we and other agencies are also responsible for enforcing it. And the Equal Credit Opportunity Act prohibits discrimination in lending, both in consumer lending and in business lending. And therefore, we have to fulfill, of course, and will fulfill diligently the mandate Congress has given us in that area.
The original bill, the Dodd-Frank Act, created new data reporting requirements that are aimed at helping regulators understand credit conditions for small, women-owned and minority-owned businesses. Some have said these requirements will be burdensome and could raise privacy concerns for those types of firms. How will you balance these concerns while ensuring policymakers have sound and accurate information on small business credit?
So, Congressman, you're referring to Section 1071 of the Dodd-Frank Act, which does amend the Equal Credit Opportunity Act to add this data collection on small business lending. And this is potentially an important source of data to better understand demand conditions and supply conditions in the market for small business lending, where data to date have tended to be somewhat limited. So we see it as potentially as a boon to have these data as a boon both to small business borrowers and to lenders to better understand the market. Now, inevitably, with the data collection, nothing is free. There's some cost involved. Congress has set the parameters for this data collection, but within that, where we have discretion about how to do it, we are going to seek to make the most of the benefits of these data for the public and only impose the burdens that are necessary to achieve those benefits. And we intend to make sure that the data have integrity and will be useful in the end. And the issue of privacy that you mentioned, of course, is an important consideration, a consideration that has arisen in other data collections. And those issues are important, and we intend to pay attention to them.
Thank you. No further questions.
Mr. West.
Thank you, Mr. Chairman, Mr. Ranking Member, and thank you for being here today. One of the things that I continually hear from our district down in South Florida is small business owners and the access to credit. Of course, everything worth reacting to can sometimes be worth overreacting to with Dodd-Frank. Do you think that we need to have regular review of some of these regulations to make sure that they are effective and efficient and not constraining as far as its relationships with our community banks and also our small business owners?
That's a good question, and the Dodd-Frank Act to some extent contemplates this because it does provide that for significant regulations that the Bureau adopts that we should be assessing the regulation within, I think it's about 5 years. And so that's a statutory requirement and one that we intend to follow diligently.
Well, I'm concerned with that because with the last jobs report that came out, small businesses are saying that they're going to freeze hiring for the next year. 70% of them said that. So if we're going to wait 5 years to go back and do a review, that's really not setting the conditions for the growth of our small businesses. So can we come back and look at a semi-annual review and make sure that we include some of the people that this could be affecting, community banks or small business owners, instead of waiting 5 years for a review?
So we have a process, in fact, a statutory process, the Small Business Regulatory Enforcement and Fairness Act, that actually provides small businesses the opportunity to provide input before we issue a proposal in certain circumstances.
Was that part of Dodd-Frank?
There were amendments. Dodd-Frank included amendments to the Regulatory Flexibility Act and the related small business, the SBREFA. And those amendments, among other things, extended SBREFA obligations to us. We're the third federal agency only to be subject to SBREFA. And that'll be one way that we get input from small businesses even before we've adopted a regulation. And I think what we're trying to do is, where we can, go beyond the statutory requirements for public comment on regulations. And a prime example of that is how we've been handling the reform of federal mortgage disclosures. Long before we've put a regulation out there that would implement these reforms to the disclosures, we put initial prototype forms on our website, and we created a channel for consumers to respond and a channel for industry to respond. And both channels have produced thousands of comments, often quite detailed comments. And we've used the wonders of the technology. We've used the internet to make it easy to comment and to click on parts of the form and give feedback on specific parts. And in addition, we are conducting sort of more controlled laboratory testing of these potential disclosures, where we're going into a room and we ask individual consumers questions about it. And I think maybe for the first time for an agency, in any event, we have found it very productive to also include in this testing lenders and brokers. So we're asking individual lenders and brokers to sit down with us, and so we can test the forms with them. And we do round after round of this sort of testing, and we'll continue to use the internet to allow thousands of others to be able to give input. So that by the time, and as I've said in my written testimony, we also plan to conduct sub-brief panels around these forms. And so that by the time we get to a final regulation, it will have received that kind of input. And then under the Dodd-Frank Act, we will, when we get to the point of implementing these newly reformed disclosures, we'll wait an appropriate period of time and come back and review it again.
And so once again, I come back to the original question. What I heard you say was right now that's 5 years. In the type of fiscal or economic situation which we find ourselves, where our small businesses are suffering, and I applaud you for looking for their input before the regulation comes in. But can we have a semi-annual or an annual review of these regulations so that once again we can go back and do the checks and balances of making sure that these things are working properly?
We can certainly consider that. I think an important factor is that when we do sort of, when we review, say if we're reviewing a disclosure, let's say we wanted to go back and test the disclosure again and see if it was still working in light of whatever changes in the market may have occurred. It's a pretty extensive process. It takes many months, and it can involve both what we call qualitative testing, where you speak to small groups of consumers and lenders, and then more extensive quantitative and statistically valid testing, something we plan to do after we finish this initial round of qualitative testing. And that can take a while to do correctly, to gather useful data. And when we do that, we want to do it in the most careful way. And we want to put out the results of our testing and research for people to learn from and to comment on and to do their own research. So the process of doing good analysis on a regulation that gives you a meaningful answer can take some time.
Thank you, Mr. Chairman. I yield back.
With no other questions, Mr. Sokolov, thank you so much for your testimony today. I really appreciate it.
Thank you.
I want to thank Associate Director Sokolov again for being here today to tell us about the CFPB, to see how it's structured, and for answering questions about how they are trying to limit the burden of regulations on small business. I hope that they will continue to think about how small businesses will be affected as they begin to exercise their regulatory authority. We will continue to closely follow the impact of the CFPB on small businesses and want to work with you to reduce the regulatory burden on our nation's job creators. I also suggest that your staff listen to our second panel of witnesses so you can learn about the concerns that small businesses have about the CFPB. I'd like now to call the second panel of witnesses to the witness table. I would now like to welcome our second panel to the hearing. For the benefit of the witnesses, I will take a moment to again explain the light system that you see before you. You will each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, the light will turn yellow. Finally, it will turn red at the end of your 5 minutes. I ask that you try to keep it to that time limit, but I will be a little lenient as you finish. Our first witness is Jess Sharp, Executive Director of the U.S. Chamber of Commerce, Center for Capital Market Competitiveness. This organization was founded in 2007 with the mission of supporting capital markets that are the most fair, efficient, and innovative in the world. Prior to becoming Executive Director at the Center, Mr. Sharp served as Deputy Assistant to the President for Domestic Policy and Special Assistant to the President on the White House Domestic Policy Council. Welcome, Mr. Sharp. You have 5 minutes to present your testimony.
Thank you very much, Mr. Chairman, Ranking Member Altmaier, and distinguished members of the subcommittee. My name is Jess Sharp. I'm the Executive Director of what we call CCMC, the Capital Markets Shop at the U.S. Chamber of Commerce. I appreciate the opportunity to testify today on behalf of the hundreds of thousands of Main Street businesses that the Chamber represents. The Chamber firmly supports sound consumer protection regulation that weeds out fraudulent and predatory actors and ensures consumers receive clear and concise disclosures about financial products. But we want to ensure that the Bureau takes a targeted approach to regulation and enforcement without making sweeping policies that would impose duplicative regulatory burdens on small businesses, and perhaps even more importantly, that would prevent small businesses from obtaining the credit they need to expand and create the jobs we need so desperately in this country. So I'm going to lay out sort of our concerns in sort of two general baskets. First, we have concerns that small businesses may be subject to the CFPB's regulation and other oversight because they engage in one of the 10 broadly described activities laid out in the law. So they could be directly supervised or regulated by the Bureau. Virtually all these businesses are already subject to oversight by the FTC. I think it's important to point out that these are not businesses that have been heretofore unregulated. The Chamber fears that overlap and duplication will be inevitable as the Federal agencies sort out lines of jurisdiction and responsibility. Second, and as has been raised here already today, CFPB regulation may decrease the availability or increase the cost of forms of consumer credit that small businesses use. We've talked about credit cards, I think home equity loans as well, auto title loans. There's a slew of sort of non-traditional commercial bank lending instruments that small businesses do rely on. And this is, of course, particularly troubling given the already challenging lending environment. According to a June 30th story in the Wall Street Journal, quote, in the past 6 months, only 17% of loan-seeking businesses with less than $5 million in revenue landed bank financing. It's a tough environment out there, and we're concerned about any tools being taken off the table. Last week, the House approved an important piece of legislation that would make changes to the Bureau's structure and operations to increase its accountability to Congress and to ensure that the Bureau's decisions are based on diverse inputs. H.R. 1315 would replace the Bureau's current single director position with a bipartisan, multi-member leadership team, giving the agency more stability and balance over the long term. And we give small community credit unions and banks a voice in the process that allows the Financial Stability Oversight Council, or FSOC, to override Bureau regulations that harm safety and soundness. The risks of agency tunnel vision, overreach, and politicization are real for any government regulator, including the Bureau. If these risks are not properly addressed at a structural level, agencies inevitably will, over time, abandon sound regulatory principles. I want to speak next about SBREFA. That's also been mentioned here this morning, and it's a very important point. As it has already been mentioned, the Bureau is included on the list now of agencies that must follow SBREFA, in addition to the EPA and OSHA. And it's a very important requirement. It's a very important requirement for the Bureau to follow in order to get small business input up front. However, the panel process is not a perfect mechanism, and it's not necessarily enough to ensure an independent check on the Bureau's activity that affects small businesses. And so this committee's role is incredibly important in overseeing the Bureau's work and its implementation of SBREFA. Just to mention a few of the concerns we have about how this process could play out. First, the Bureau itself is responsible for the threshold determination that a proposed regulation is expected to significantly impact a substantial number of small entities. And the terms significant and substantial are basically subject to the CFPB's discretion to define. Pardon me. Second, the Bureau does not have to adopt the panel's recommendations, which are advisory, and need only supply a reasoned explanation for adopting or rejecting them. Third, SBREFA covers only the rulemaking process, and I think you heard the first witness describe, Mr. Sokoloff described, that regulation isn't always the best way to go about doing things. They can use compliance assistance, they can use supervision, they can use enforcement actions to essentially dictate broader policies. And of course, none of those are subject to SBREFA or to any sort of formal process whereby small business input is taken. And just to, again, put a fine point on it, I mean, actions do speak louder than words, and as has been mentioned here this afternoon, the Bureau already does have rulemakings essentially in progress, if not technically. One to merge these two mortgage forms, another to define the types of businesses that the Bureau will supervise in the non-bank space. And in neither case has a SBREFA panel been put together. Now, technically, I guess it's not required at any particular stage, but if we want to get this right from the beginning, we would encourage the Bureau to begin that process as soon as possible. So with that, I thank you all for having me here, and I'm happy to answer questions.
Thank you. I would now like to introduce our next witness, who came here all the way from my home state of Colorado, Mr. Terry Jones. Mr. Jones is from the city of Castle Pines, Colorado, where he resides with his wife, Carol. Terry Jones has over 40 years of experience working in the mortgage banking industry. Terry is testifying on behalf of the Colorado Mortgage Lenders Association, where he serves as chairman of their Legislative and Regulatory Affairs Committee. I'm pleased that Terry Jones could be here today, and I look forward to your testimony. Mr. Jones.
Thank you very much, Chairman Kaufman, Ranking Member Altmaier, and distinguished members of the subcommittee. The Colorado Mortgage Lenders Association is a 56-year-old organization made up of over 100 companies employing over 2,500 individuals. Over 75% of our members are small businesses that employ less than 25 people. In my 42-year career in mortgage lending, I've been a loan originator, a manager, an entrepreneur, and a small business owner. I've always been proud to be part of an industry that helps people and families reach their dreams of home ownership. I've seen many people in the business start as loan originators and then go on to start their own small mortgage lending businesses. These people have lived their own American dream, and in doing so have served the real estate markets and the buyers and borrowers of their local communities. The Dodd-Frank Act creates a super regulator for the mortgage lending industry in the CFPB. This is in addition to the oversight already in place by the states, FHA, VA, Fannie Mae, and Freddie Mac. The CFPB is tasked with issuing more than 100 mortgage lending rules over the course of the next 18 months. It will be difficult for small mortgage lending business to keep up with so many new rules in such a short time frame. So it is essential for the CFPB to develop an orderly process for its rulemaking initiatives, not only to ensure meaningful input from industry, small business, and other stakeholders, but to develop well-conceived and clear rules that are neither duplicative nor in conflict with those of the states and other agencies. The CFPB must also develop a process for providing timely, reliable guidance to the industry and to the state regulators well prior to the implementation of new rules. We believe that the CFPB has a historic opportunity to set the tone for the future regulation of the mortgage lending industry in finalizing the ability to repay rule and defining the qualified mortgage as a safe harbor characterized by traditional, well underwritten, and properly documented loans. By pursuing such a course, the CFPB can help to preserve the best practices and products of the industry, yet still curb the abuses of the early 2000s. If the CFPB takes this approach, it will be of great benefit to small mortgage lenders because it will create a safe, clear, safe harbor that they can rely on when making loans. If the CFPB chooses to adopt the qualified mortgage as a rebuttable presumption, we believe that the increased levels of litigation will force many small lenders out of business. The CMLA believes a qualified mortgage safe harbor will define the arena in which most loans will be made. The risk to smaller business in particular will be too great for most of them to venture outside the qualified mortgage parameters. Consumers in Colorado and across the country need a viable small business mortgage lending industry to provide a competitive local alternative to the large national lenders that dominate the marketplace today. The CFPB is also responsible for enforcement of the SAFE Act, which requires loan officers for non-bank firms to meet education, testing, and financial standards, while bank loan officers need only be registered. This creates an unlevel playing field and additional costs for small non-bank lenders and creates unequal protection for consumers. In addition, licensed originators can move freely to depository lenders from licensed originators, but the reverse is not true. That a loan originator working for a bank will have to go through the entire licensing process in order to be able to be employed by a small business lender. We ask that the CFPB undertake rulemaking as soon as possible to create a transitional license to allow registered loan originators to move from depository institutions to non-bank lenders for a limited time while they complete their licensing requirements. Finally, it is important for the CFPB to address the loan officer compensation rule under the Truth in Lending Act and reconsider some of the rigid requirements that were recently imposed by the Fed on the ability of a small business to pay its employees in a manner consistent with the profitability of the loan products they produce. Confusing standards and lack of official guidance from the Fed has created some unusual outcomes. For example, the current rule severely impacts revenue bond programs that serve low to moderate income and rural borrowers. These programs typically limit fees and that can be charged to the borrower, yet the loan officer compensation rule specifies that the loan officer must be paid exactly the same on these loans as any other. This can easily cause losses on these loans, and many lenders will be unable to offer these programs, these affordable loan programs. We urge the Bureau to clarify this and other problematic issues with the compensation rule. We respectfully urge Congress and this subcommittee to carefully monitor all of these new rules and to be certain that they do not unwittingly harm American families, small business, the mortgage market, the housing recovery, or the nation's economic recovery. I thank you very much for the opportunity to testify before you today.
Thank you, Mr. Jones. I would now like to recognize Ranking Member Altmaier from Pennsylvania, who is going to introduce our next witness.
Thank you, Mr. Chairman, and it is my pleasure to introduce Adam Levitin. Mr. Levitin is professor at the Georgetown University Law Center in Washington, D.C., where he teaches courses in bankruptcy, commercial law, and consumer finance. He has previously served as a scholar in residence at the American Bankruptcy Institute and as special counsel to the Congressional Oversight Panel supervising TARP. Before joining the Georgetown faculty, Professor Levitin practiced law and served as a law clerk for the U.S. Court of Appeals for the Third Circuit. Professor Levitin holds a J.D. from Harvard Law School and degrees from Columbia University and Harvard College. Welcome, Professor Levitin.
Mr. Chairman Kaufman, Ranking Member Altmaier, and members of the committee, good afternoon. My name is Adam Levitin. I'm a professor of law at Georgetown University Law Center. My research and teaching focuses on consumer finance and financial regulation. I'm also a small business owner. The Consumer Financial Protection Bureau has only limited and generally indirect connections to small business finance. With three very limited exceptions, the CFPB's jurisdiction is restricted to consumer financial products. While many small businesses use consumer financial products, like personal credit cards and home equity lines of credit, for business transactions, small business owners need, deserve, and want the same protections on their financial products, whether they are using them for personal or business use. Thus, the National Small Business Association has advocated for extending Truth in Lending Act protections to small business credit cards. Now, there are only two ways the CFPB might directly affect small business lending. First, the Dodd-Frank Act requires the CFPB to collect data on small business lending under the Equal Credit Opportunity Act. This is to ensure against discriminatory lending in the small business space. The ECOA data collection requirement will impose some limited costs on lenders, but it will also provide an important protection for small businesses, particularly those owned by women and people of color. More generally, though, the CFPB has regulatory authority over almost all consumer financial service providers, large and small. The CFPB regulations could affect the cost or availability of business credit, but I want to emphasize it is simply premature to judge the CFPB's impact on financial service providers, or the impact of the CFPB on small business credit costs and availability. Instead, individual rules will need to be evaluated on their own merits when and if they are proposed. The Dodd-Frank Act imposes numerous safeguards on CFPB rulemaking to ensure against unnecessary regulatory burdens. CFPB rulemaking and adjudication is subject to the Administrative Procedures Act. It's also subject to the Regulatory Flexibility Act. The CFPB is one of only 3 agencies required to have regulatory flexibility review panels under the Small Business Regulatory Enforcement Fairness Act. The CFPB is also required to consult with prudential regulators on its rulemakings and to reevaluate those rulemakings within 5 years. Additionally, the CFPB is subject to Financial Stability Oversight Council review for its rulemakings, which is unlike any other bank regulator. Finally, small banks and all but 3 credit unions are exempt from CFPB supervision and enforcement. Their supervision and enforcement remains with their existing prudential regulators. Now, I want to emphasize that this is a battery of safeguards that does not apply to any other bank regulator. It's also important to note that the CFPB is likely to help small businesses. The CFPB can help improve competition in small business lending by ensuring that consumer financial products, which are used by small businesses, are fair and transparently priced. Small businesses want to use fair and transparent products. Second, the CFPB can help small businesses by helping small business customers. When consumers feel confident that they won't get caught by financial product tricks and traps, they're going to have greater willingness to make purchases, including from small businesses. And the CFPB can help protect against consumer asset bubbles and thus smooth the volatility of consumer spending. That means a more stable business environment, which benefits small businesses. In short, the CFPB has limited jurisdiction over small businesses. It's subject to numerous safeguards to ensure against excessive regulatory burdens on small business, and it may be able to help increase the efficiency of small business lending by increasing consumer confidence and spending stability. Thank you very much.
Thank you, Mr. Levin. The final witness to testify here this afternoon is Daniel Fleming, president of Fleming Leasing, a truck renting and leasing business located in Springfield, Virginia. Fleming Leasing is a family-owned business founded in 1903 with the transportation services they were providing consisted of a horse and buggy when they started. Mr. Fleming is testifying on behalf of the Truck Renting and Leasing Association. Mr. Fleming, you have 5 minutes to present your testimony.
Thank you, Mr. Chairman. Thank you, Mr. Altmeyer. As you said, my name is Dan Fleming. I'm president of Fleming National Lease in Springfield, Virginia, and our company is a member of the Truck Renting and Leasing Association, or TRALA. I'm testifying today on a troubling aspect of the Dodd-Frank Act, namely Section 1071, the Small Business Loan Data Collection Provision. Fleming National Lease is a family-owned business with 18 permanent employees in locations in Springfield, Virginia, and Landover, Maryland. We're a proud member of TRALA, an association comprised of about 550 companies, employing 100,000 people and operating out of 24,000 locations throughout the United States. Not only are nearly all of TRALA's 550 members small businesses themselves, but the vast majority of the customers that we deal with are also small businesses in search of vehicles and equipment offered for rent or lease at a reasonable price. Part of the process in acquiring rented or leased vehicles is to fill out an application of credit. As written, Section 1071 adds extensive new application requirements to the ECOA. These requirements would be offered by and monitored through the CFPB. While they certainly do not operate a bank, under the definitions listed within this new law, I am considered a financial institution because I have an application for credit for my customers. In my opinion, the small business data collection provision is counterproductive, contradictory, costly, and confusing. The provision is counterproductive in that the CFPB was created with the intention of giving consumers protection from the predatory lenders and allowing them to find more options for information in obtaining a loan, but instead is now intended to regulate commercial loans and lenders. Section 1071 is contradictory in that the statutory language conflicts with existing language already on the books. My understanding is that Section 202.5 of Regulation B under the ECOA explicitly says a creditor shall not inquire about the race, color, religion, national origin, or sex of an applicant. The personal information should have no basis in determining whether or not someone receives a truck from Fleming National Lease. In terms of cost, this could cause a real strain on my bottom line. According to Section 1071, after a lender inquires whether an applicant for a loan is a minority, women-owned, or small business, no one involved in the credit decision can have access to this information. This would require me, the so-called lender under this definition, to completely alter my application process, which would be expensive. If we were to comply with this new regulation, I estimate that we would have to, at a minimum, hire a new part-time employee. That could cost our company somewhere between $10,000 and $20,000 annually. And while that doesn't seem much in the scheme of things, for me it's money that could be spent hiring another mechanic or purchasing a new vehicle, both of which in turn makes my company more profitable, but instead would be spent on more administrative burdens. Lastly, Section 1071 is extremely confusing and leaves many questions unanswered regarding what information I am to collect and what definitions will be used to ensure compliance. There also remains a concern over whether or not the CFPB and the Federal Reserve will work jointly to rectify issues that could remain from any exemptions that exist. Just to touch on this final point, since Section 1071 amended the ECOA, both the CFPB and the Federal Reserve now have jurisdiction over entities such as auto dealers. I believe it's imperative that if this new law was to be enacted and enforced, regulators must coordinate their implementation of these new requirements. If not, financial companies might receive different data from the dealers than that which would be required to file with the CFPB and open an entirely new problem. While I recognize the fact that the CFPB has now decided it will issue a formal rule that hopefully will address and answer some of the confusing qualities within the law, ultimately I remain unconvinced that there is even a reason to have such a rule implemented for businesses like my own. I'm not a banker. I lease trucks. To be placed in the same category with a multi-billion-dollar financial giant makes absolutely no sense to me. In my opinion, making a truck leasing company or any small business comply with Section 1071 is a mistake. Thank you for allowing me to issue my testimony today.
Thank you, Mr. Fleming. Questions? I'll start with Mr. Jones. On a scale of 1 to 10, how would you rate the CFPB's outreach on the mortgage disclosure forms that they are currently in the process of revising?
Thank you, Chairman Kaufman. I would rate them at a 6 or a 7, and especially compared to previous regulatory form changes. I think they really have reached out and provided an opportunity for our members and members of the mortgage lending community to comment on those forms.
Thank you. With your 40 years of mortgage lending experience, can you tell me what happens if an entity is seen by its customers as being abusive?
I think if an entity is seen by its customers as abusive, basically they stop using the lender. I think good businesses in our business and any business have to be close to their customers. And that, I think, is one of the real benefits of being a small business and being located with your customers in the same towns and going to the same meetings and the same social functions, same churches. So it's critical that you have good customer relationships.
Mr. Sharp, we hear frequently that there is a fight between Main Street and Wall Street. However, our economy is interconnected, and we must make sure both are healthy if we want to grow our economy. Can you tell me about the impact that financial regulations will have for Main Street small businesses?
Yes, Mr. Chairman. Thanks for the question. As I said in my testimony, I mean, it's hard to know exactly what the impact will be, and I think we heard that from the first panel as well. But again, our concern is that you know, small businesses have the hardest time and the most expensive time, really, complying with new regulations. And as you know, there are a flood of regulations headed their way. And in this case in particular, obviously, again, our concern is that some companies may be directly regulated who didn't expect to be regulated, as my my fellow panelist, Mr. Fleming, has mentioned, and others may find that access to credit lines or to credit instruments that they rely on are either more expensive or unavailable. So there's no way to know for sure what the impact is going to be, but those are the two areas where we're hopeful that there won't be an adverse impact.
Can you tell me how small businesses use the equity in their home to finance small businesses, particularly in the early stages of development? Sure.
I think it's pretty widely accepted that particularly the very smallest businesses, sort of the two guys in a garage, kind of very earliest stage of a small business. And I think if you look at Google or some of the real tech giants these days, you can trace almost all of them back to, again, a couple guys in a garage with either a personal credit card or someone borrowing against their house or borrowing against their car. Now, of course, you grow out of that phase at some point, and you have access to the capital markets, but it's each of those tools, which are not designed to be for commercial lending, have become critical lifelines for small businesses.
Right. Based on your experience in government and observing the CFPB, do you think they are prepared to assume authority, or do you feel that they have been rushed?
Well, a year sounds like a lot of time, but it's really not to stand up a brand new agency, particularly when you have a responsibility to sort of gather up bits of law. I think in 7 other agencies, I think it's 19 statutes that they are consolidating under one roof. So we do have a concern that they're moving awfully fast. We don't, I think on the transfer date they began to issue, the CFPB began to issue interim final rules, which essentially says this is the final rule, but we're going to continue. We're going to take comments and adjust as needed. And in some cases, that's probably good. In some cases, we may have concerns. We're trying to keep up as well. But I don't think a year is enough time for this Bureau to have gone active, particularly without a confirmed director. I think that also creates serious challenges for them.
Right. Mr. Fleming, you mentioned compliance costs in your testimony, but can you reiterate how much will it cost for your business to comply with the new data collection requirements?
Well, again, Mr. Chairman, I'm estimating that we could potentially have to add at least a part-time clerk, which for us, as such a small business that's so flat, that's really a significant investment for us for really a position that doesn't add to the bottom line. I'd prefer to spend those funds on, as I said, a mechanic or some equipment that adds to revenue for our customer. We are constantly looking for good qualified diesel technicians to fix our trucks, to keep them out on the road, to help produce revenue for our company. So while, again, I said one part-time position seems small, that'd really be better used in a revenue-generating type position rather than just an administrative burden to comply with potentially new Federal regulations.
Do you feel taken advantage of by the banks that you work with? If so, would you just switch banks or providers?
We did switch our banking relationship. I wouldn't say felt taken advantage of, but just didn't feel that it was working for us, and we had a relationship with banks out in Ohio and changed those banking relationships. I think as other members of the panel said, it's a free market, and there's certainly plenty of other opportunities for us, and we took advantage of other opportunities when they presented themselves.
Thank you. Mr. Levitin, according to the SBA Office of Advocacy, small businesses create 7 out of every 10 jobs in America, yet in a recent article you claim that small businesses' contribution to long-term stable employment is limited. Do you disagree about the importance of small businesses in helping our country recover from 9% unemployment?
No, I do not disagree with that. I'd actually point out that what I said is entirely consistent with the Small Business Administration's Office of the Advocate, that small businesses create a tremendous number of jobs every year, but the general story of small business is unfortunately failure. Most small businesses don't last for more than a couple years. So instead, you just get churning rather than stable long-term employment.
Okay. As a professor, I would assume that you see the value of lawyers drafting contracts and committing agreements to writing. This creates certainty. How can plain language increase certainty in contracts? I can see the value in getting rid of some legalese, but don't contracts require some specific language that cannot always be made into quote-unquote plain language?
It really depends on the specifics here. So, I think the CFP, I think where your question is going, if I understand it correctly, is how is the CFPB going to help make markets more efficient? And getting rid of unnecessary legalese is certainly something I think everyone at this table would think is a wonderful thing. That's move one. But as you point out, not everything can be boiled down to legalese. The second part is simply ensuring that when a business goes out, or a consumer, actually, well, really a consumer goes out and compares financial products, they can compare them on an apples-to-apples basis. That's actually very difficult to do right now with many financial products. It's not like going to a grocery store where there's unit pricing and you can see the cost for an ounce of orange juice of brand 1 and an ounce of orange juice of brand 2. Instead, many financial products are designed in a way that they're too complex to compare on an apples-to-apples basis, knowing what the all-in cost will be. The CFPB may be able to improve that by encouraging standardization of financial products to the things that consumers really want.
Thank you, Mr. Altmaier.
Thanks, Mr. Chairman. Mr. Levitin, I wanted to follow up on a question I asked to the earlier panel regarding the fact that many entrepreneurs use personal credit cards and home equity loans to finance new business ventures. Many of you mentioned that in your testimony. How should, in your opinion, the CFPB account for these small business owners when drafting regulations specifically for credit cards and home mortgage products? Well, as someone who actually uses a small business credit card for some purchases, that I think it's important to note that that many small businesses use the same credit card for both their business transactions and personal transactions. And so say you're going and filling up your car with a tank of gas, and you use that car partially for business use and partially for your personal use. You want to make sure that I think you would want the same protections on that transaction, because you don't know whether you don't know whether that gas you're putting in the tank is going to be used for when you're driving your kids to the soccer game, or whether you're using it for work. You don't know at that point whether you're doing a business transaction or not, ultimately. And in situations like that, small business owners should have the same protections that they have when they are consumers. For Mr. Jones, over the past 3 years, we've unfortunately learned that bad mortgages are costly to everybody, and to be successful, your business in particular has had to make loans that borrowers can repay. Is there, in your opinion, a potential benefit to the mortgage industry if the CFPB's ability to repay rules are structured appropriately?
Thank you for the question. Yes, I think so. The ability to pay rule, again, if it's characterized as a safe harbor, which will provide a bright line for, especially for small lenders that don't have the ability to hire the compliance staff. If you have a 25-person business and you need to hire an attorney to help you with the rules and regulations, it becomes a very burdensome endeavor. So it's important if they do characterize it as a safe harbor that is clearly interpretable by small businesses. I think it will be a vast boon to our industry and to the consumers of America as well.
Thank you. For Mr. Sharp, many in the banking industry have expressed concern that the Dodd-Frank Act will stifle lending to small businesses, another point many of you brought up. Hasn't the small business community been struggling to get credit from banks since well before the financial reform was enacted? And is there something that could be done perhaps outside of this law or something different to help correct for that?
Well, thank you, Mr. Altmaier. First of all, I mean, to answer the first part of your question, yes. I mean, the challenges that small businesses face in the credit markets right now are not, unique to 2011 or 2010. I mean, they've been around for several years now, and it's stagnant. It's not improving, and that's a real concern. Honestly, at this point, I think part of what everybody's hearing is let's not do anything to make it worse. It's not exactly clear what it is that is gumming up the works. But when we know for sure that, again, the commercial lending markets are not frozen, but they're not in good shape, sort of our message and the message we're hearing from our small business and Main Street members is, let's certainly not take away some of these tools that do seem to be working well now. We can still use our credit cards. We can still borrow money against our car title or our home. Even those markets are functioning fairly well. So their message to us is do no harm, essentially, and that means working closely with the CFPB to make sure they understand the knock-on effects to the small business lending world and the actions they're taking.
Thank you, Mr. Chairman.
Mr. West.
Thank you, Mr. Chairman, Mr. Ranking Member, and thanks to the panel for being here today. Mr. Sharp, I'll ask the first question to you, and others from the panel can chime in. What do you really see in your assessment the purpose of the CFPB to be?
I believe the purpose of the CFPB is to find fraudsters in the consumer products market and put them out of business, or clamp down on their fraudulent practices, protect consumers against bad actors in the market.
Okay. Anyone else?
I would say that's part of CFPB's mission, and that's an important part, but it's broader. CFPB's mission is to ensure that we have fair, transparent, and competitive consumer finance markets. And that's not just getting rid of fraud. That's also ensuring that disclosures are clear, that we can have good price competition in the market.
Have we had, prior to this, any other government agency or someone else that was doing this? I mean, do we see this as a redundancy, or do we see this as some type of duplication of effort out there from the government?
Prior to the Dodd-Frank Act, some parts of the consumer finance space were regulated by a laundry list of federal agencies, and this is one of the problems, that you had a regulatory market that was splintered. So you had the Federal Reserve, the FDIC, the Office of Comptroller of the Currency, Office of Thrift Supervision, even the Department of Defense and HUD, each having little spaces in the market, and many things fell between the cracks. And also those missions, the consumer protection mission given those agencies was typically a secondary and subordinate mission to other missions, particularly to bank safety and soundness, which is just a fancy term for bank profitability. So abusive lending practices, the only reason to do them is that they're profitable. Banks don't do them for fun. They do them because they're profitable. But if you're the comptroller of the currency and you see your primary mission as ensuring that banks are profitable, that puts you in a bit of a bind where you're going to be tempted to turn a blind eye to abusive practices because they're profitable. And that's what we saw. That's what led up to the housing bubble.
Okay. So in your assessment for the panel, this was something that we needed to institute. This was an agency, a bureau, or a government program, whatever you want to call it, that we needed to institute.
Without a doubt, that the financial crisis in 2008 came out of consumer financial products, out of mortgage products. That was the root of it. And if we want to ensure that doesn't happen again, we need to have better consumer financial protection.
I'll just say, it's no secret that the Chamber didn't support the creation of the Consumer Protection Bureau. And at this point, our focus is on, it's there, it's up and running, it's no longer an idea on paper. Our concern now is as the gears begin to turn and it begins to issue regulations and begins to do its work, our concern is that it not become a sort of duplicator of other agencies' work. And there are some cases, at least one very obvious one with the Federal Trade Commission, where the Bureau's jurisdiction and the Federal Trade Commission's jurisdictions overlap. And that was intentional to some degree, and the law requires the two agencies to prevent sort of stepping on each other's toes, to prevent situations where they're duplicating or conflicting with one another. But we do have concern, sort of a general concern, that that will be very difficult to avoid.
Mr. Jones, Mr. Fleming, do you believe that the CFPB will enhance free market competitiveness and entrepreneurial spirit or not?
Mr. West, thank you for the question. I think we were happy to see the CFPB's move towards consolidating the truth in lending and the good faith estimate disclosures, two forms that have been a challenge for the industry, being administered by formerly by two separate Federal agencies that did not always see eye to eye in terms of what should be done. So we do think there's real benefit there. Another benefit to our industry could be is that our industry is very heavily involved in automation in order to comply with the multiplicity of rules and regs that we have. And to the extent, I was very encouraged today to hear that the CFPB will be doing an economic, cost-benefit analysis to really determine whether or not, and to the extent that that is what we do, then I think it can be a boon to not only to the industry and help to lower some costs, but it also will be a boon to consumers who hopefully will have less confusing and clearer disclosures. So there definitely are some benefits.
Mr. West, since I'm a trucker and not a banker, I would be hard-pressed to express an overall opinion of the CFPB. What I'm primarily concerned about is just, any new regulations that seem to me, as someone sitting down in Springfield, Virginia, shouldn't really apply to me all of a sudden, coming down and creating new regulatory requirements. So from that perspective, I'm concerned about that section. But overall, I'm certainly not in a position to register an opinion on the group as a whole. So thank you.
Very well. Mr. Chairman, I yield back.
Thank you, Mr. West. If you had, to each of the panelists, if you could identify just one top issue that bothers you about CFPB, this is the top issue that you think ought to be changed or improved to improve it, what would that be, Mr. Jones?
Thank you, Mr. Chairman. I think our top issue with the CFPB will be the clarity of the issues and the clarity of the rules and regulations that are issued, and the ability to receive and respond to industry input prior to those regulations being implemented.
Mr. Sharp.
Mr. Chairman, our primary the changes that we're pushing for primarily are structural. It's very difficult, as I think we've all discussed today, to know exactly where what problems may arise and when, in what what sector. So what we're advocating for is expanding replacing the single director with a panel and ensuring that safety and soundness isn't compromised through a more effective check by the prudential regulator. So at this point, we think that sort of the best long-term hedge against poor policymaking by this agency or any other independent agency is sort of collaborative decision-making at the top with input from diverse sectors, bipartisan input. So that's our top priority.
Mr. Fleming.
Mr. Chairman, I think I would just ask the organization to take into consideration unintended consequences, such as these data collection requirements that maybe in theory would be of interest and be helpful to the organization, however, be burdensome for us small businesses that would have to comply with these new regulations to provide the data. So,
Mr. Levitin.
As you might have guessed, I'm going to give a rather different answer. I think if the two most important things with the CFPB are, number one, that the Senate should confirm a director, and number two, if you really wanted to start changing the scope of CFPB regulation, I would strongly urge subjecting auto dealers and realtors to CFPB regulation. There's not a very good principled argument for exempting them.
Thank you. Mr. Altmaier, any? No further questions. Thank you, panelists. I just want to thank you all so much for taking the time to coming down to Capitol Hill and testifying today on this very important matter. With that, committee is adjourned.